Hello again. I'm Raj Malhotra, Senior Trading Mentor. So the month of May has had some really surprising moves and some real surprising correlations versus historical data. So as I'm filming this, the broad-based S&P is up around 4%. However, that is pretty much where the S&P was at the end of March. So all we've done is basically reverse April's losses. Tomorrow's CPI number, of course, can change all that, but that's where we are right now. Same reversal of losses pretty much holds true for both the small cap Russell and the NASDAQ 100. So having said that, looking under the hood, we've seen some broadening out of this rally. And what I really want to do today is highlight some of the surprising correlations. There's been a real divergence in the commodity complex. If you look at oil and oil-related stocks, they've pretty much done nothing since the end of March. However, commodities like copper have had up 20% move in the same time period. So I've been lucky enough to ride that move in copper and related names like FCX, Freeport, and Southern Copper, SCCO. Both of those are up close to 20% in the same time period. One that's really caught my eye, which I haven't been involved in, is this explosive move in cocoa futures, which have almost doubled since the beginning of the year. Now, one would think that a company that's so reliant on cocoa as an input, a name like Hershey that makes chocolate bars, as you must know, would be really struggling here. But as you see here, year to date, Hershey's up about 9%, which is basically up in line with the S&P. So that's also been a bit of a surprise to me. Emerging markets have actually outperformed the U.S., and shockingly, China's been leading the way. China's up 15% since the end of March, and that continues to look to break out. Even certain biotech stocks are having their day in the sun. Surprising, some of them are actually COVID related. I mean, lucky for me, Novavax and VX has exploded. You should see here to the upside this month. But that's pretty much due to a partnership they announced with Sanofi. So if you're looking at biotech, there may be opportunity in this sector, but you have to know what you're doing and you have to be look at very specific names. Having said all that, the most surprising move in my mind in this market, ignoring meme names like GameStop and AMC, now that Roaring Kitty and Anal 69 love are back, has been the move in the boring utility sector. The XLU, which is the utility ETF, it's up over 10% since the end of March. And remember, utilities are traditionally one of the lowest volatility sectors, as well as very recently very underloved. I want to highlight how extremely rare it is for utilities to ever lead in an up market. Utilities are usually very defensive in nature, and they only lead when the market is weak and people buy utilities as a flight to safety due to its consistent cash flows and its dividends. In bear markets in particular, utilities and consumer staples usually lead. And when I mean that they lead, I mean that they are either not down or they are down the least, but usually not up. Even with this recent move, the XLU is up only about 6% in the last year versus a 27% plus up move for the S&P 500. So in my mind, there still may be room to run here. I mean, yes, people will point to the 10-year yield, which has come down since the April job numbers as an impetus for why utilities have rallied. But this move has still been surprising. Remember, lower rates should be good for utilities. That's true, given their high dividend payouts often make them as an attractive alternative to other yield products. However, the 10-year yield, as I film this, is trading around 4.45 and was trading around 4.2 at the end of March, the time period I'm referencing. So it is still lower. It was still lower back then. So again, that's historical versus this current correlation just doesn't make a lot of sense. And remember also this XLU dividend yield is trading about 3.25, which is still a lot lower than the current 10-year yield. So why are they so strong, and will this continue? I mean, like I said, there has been a broadening out of this rally, and utilities may have been a beneficiary. Now, of course, the same people that have missed the move in utilities are now saying utilities are overbought. Well, that might be correct, but that doesn't mean there isn't more room for utilities to resume its uptrend once that gets flushed out of the market. So more importantly, are there any fundamental reasons for utilities to rally despite rates, being at this level? Well, one theory, which I think is actually has some traction, is the rise of AI. Yes, really, AI. Just hear me out. So if you look at Q1 earnings, Microsoft and Amazon have stated they're spending more money on their on the next generation chips, and they're building data centers to power their AI push. So what does that mean? That means that they're building these data centers, and these data centers require more power. And the theory is that these utilities that are particularly focused on clean energy and nuclear power will totally benefit from this demand surge. Remember, utilities usually make the market nervous if they're leading because that's supposed to be a defensive positioning. Now, I think that this case is different because of what I just said in terms of AI. However, one thing you have to do is don't blindly go buy utilities. You have to do your fundamental work and pick names that are specific to the AI thesis. And don't buy dinosaurs and shitbag companies like Con Edison, which is my utility provider. In particular, I'm also looking for if I'm looking for a continuation of this trade, I want to look at companies that are in regions that tend to be growth oriented. So I'm looking at companies in Texas because remember another thing about utilities they're a regional play because they essentially operate as a local monopoly, as I highlighted in a recent Flash episode. So one of the companies that fits both the AI and the regional narrative is NRG Energy, ticker NRG. So the stock's had a pretty big move higher this year, but I still think there are tailwinds. If you look at their transcript, their last quarter, their numbers were solid, but not amazing. However, one thing I did like is in the process of shifting their energy allocation resources more into their smart home, their home energy divisions. So those moves should boost profit and revenue. If you look at it on a fundamental basis, the stock is still pretty cheap, even with this big move higher. It still has a sub 12 PE. And their activist investor at Elliott Capital is really having them focus on renewables and trying to really have them focus on the growth part of this utility business, which I really think that they will. So in terms of trade structure, I'm not so sure about the timing, so I tend to want to be agnostic on the timing. So what I did here was I set up a 2-to-1 ratio where I want to buy 12 of the July 85 calls for $4 each and sell 6 of the June 90 calls for $1.20 each. If you do that, you spend around $4,000. The stock rallies 20% to say 105 by July expiry. I can make a 5-to-1 risk reward if all things break right. Like I said, I think there is also a lot of opportunity in other underloved sectors, such as utilities. I've highlighted some of these earlier, such as certain commodities, emerging markets, biotech, just to name a few. I'm also trying to focus my long exposure on small and mid-cap names that are sub $20 billion, like NRG. Now, of course, a hot CPI number can change this whole narrative and reverse rates, and maybe the 10-year will start approaching 5 again. But with the data I'm looking at, I just don't see that happening in the short term. So with that, here's my advice. Go do your homework, find the next Novavax, Freeport, or hot utility like NRG. With all that, I'm Raj Malhotra. I'll see you guys in the winner circle.